Futures, unlocking the secrets of tomorrow's trades. Imagine a world where you could predict the future, at least when it comes to the price of goods and assets. That's the promise of futures contracts, a powerful tool in the investing world. But here's where it gets controversial. These contracts can be a double-edged sword, offering both immense opportunities and significant risks. At their core, futures are simple. They're agreements to buy or sell something at a set price on a specific future date. It's like a bet on what the world will look like months or years down the line. But the outcomes can be anything but simple, as global events and economic factors often throw curveballs. Take the case of Arabica coffee in early 2025. Prices hit record highs, causing a ripple effect that impacted consumers and markets alike. Imagine being a coffee roaster who had locked in a price 3 months earlier. Despite the price surge, you'd still pay the lower agreed-upon price. It's a win for you, but a loss for the market as a whole. This is the beauty and the beast of futures. They provide certainty in an uncertain world, but they also create winners and losers. And this is the part most people miss. Futures are not just about buying and selling. They're about managing risk, and for some, making speculative bets. The modern futures market has its roots in the mid-19th century, with the establishment of the Chicago Board of Trade, CBOT. In the United States, before this, farmers and merchants had to rely on informal, trust-based agreements, which were often risky. The CBOT changed the game by introducing standardized contracts and rules, making futures trading more reliable and accessible. Over time, futures markets expanded beyond agriculture, covering a vast array of assets from crude oil to cryptocurrencies. The core purpose, however, remains the same: locking in a price today for a deal tomorrow. So, why do futures exist? Primarily, they're a tool for managing risk, a practice known as hedging. Take a wheat farmer, for instance. If they're worried about prices falling before harvest, they can sell a futures contract, locking in a selling price and reducing the risk of financial loss. On the flip side, a bread company might fear rising wheat prices. By buying a futures contract, they secure today's price for their future wheat needs, protecting their business from sudden cost increases. Futures are also used for speculation. An investor might buy a crude oil futures contract, expecting prices to rise. If their prediction is correct, they can sell the contract at a profit. However, speculation carries significant risks. If prices move in the opposite direction, the speculator could incur substantial losses. Another critical aspect of futures trading is leverage and margin. Futures allow traders to control large positions with a small amount of capital, amplifying both gains and losses. Even small price swings can result in losses exceeding the initial investment, highlighting the importance of careful risk management. In essence, futures speculators are paid to assess risk in complex markets. Whether it's hedging or speculation, futures offer price certainty, allowing buyers and sellers to plan ahead. This stability is a boon for businesses and markets, especially during uncertain times. Common types of futures: commodities. Physical goods like gold, oil, coffee, and wheat. These markets are vital for industries reliant on raw materials. For instance, airlines use oil futures to lock in fuel prices, while food producers hedge against fluctuations in grain or coffee costs. Financial instruments. Stock index futures, interest rate futures, and currency futures allow investors to trade based on financial market performance. Institutional investors often use these to hedge large portfolios, speculate on rate changes, or manage currency exposure in international trade. Cryptocurrencies, Bitcoin, and other digital currency futures have gained prominence, offering new avenues to trade this volatile market. Traders use them to speculate on price movements without directly holding the coins, and exchanges now offer both regulated and offshore options. Futures markets cover a wide range of assets, from natural gas to livestock, lumber, and even weather events. As long as an asset has a measurable price, adequate liquidity, and active participation from buyers and sellers, a futures market can be established. This flexibility makes futures a versatile tool for both risk management and speculation. Futures versus spot trading. Spot trading is straightforward. You buy or sell something and receive it immediately. Think of buying gold coins from a dealer. Payment and delivery happen right away. Futures trading, on the other hand, is a delayed transaction. You agree to trade at a set price, but the actual payment and delivery occur on the contract's expiration date. In gold trading, for instance, prices agreed upon today are unlikely to be affected by future price swings, which can be challenging to predict. Futures can be used for hedging or speculation, while spot trading is more suited to immediate needs. Understanding a difference is crucial for investors and businesses to choose the right approach for their goals. So, are you ready to dive deeper into the world of futures? What are your thoughts on this powerful yet controversial tool? Share your insights and experiences in the comments below.